I got this off the. I recorded it off of the course I was taking, but I think it's an apt description. The animation is much better than I can do. Anyway, the concept is the same. You see these two bars side by side. It's just showing you where the wicks are, where the bodies of the bars on these two separate bars are. In the first case, we have a bear bar. Second case, we have a slightly bullish bar. But when you add these two bars together, this bullish bar and this bearish bar and this bullish bar winds up with a slightly bearish bar, with a little bit of body and this much longer wick. Now, the reason that you add these two bars together is that you see this bar looks completely different, the single bar, from the two previous bars, so you took them individually. The idea is to try to gain perspective on a series of bars and to see whether or not markets are in balance or markets are trending. And if you take a bunch of bars and put them together, after practicing, you can see that these two bars, the bearish and the bullish bar together, winds up with a bar that is relatively neutral, maybe only slightly bearish. Okay, despite the fact that the previous bar was more of a bullish bar. So when you look at a series of bars side by side, you can make a better judgment, in my opinion, as far as determining whether or not the series of bars are going to lend toward give you some perspective on the context of the marketplace. Now, let me show you how it works when you have another series of bars and add them up. The idea that I've got here is that let's say that you have a stop below here. This is your hard stop. This is where your target is, which is the green line. And it's flagged as a valid entry. Now, once you get the entry, your bar goes up. We have a slightly bullish bar, and things look pretty good. On the next bar, it's bearish, so really back at your entry price. After a little while longer, you get another slightly bearish bar, or bullish bar, I mean. Another bearish bar, this is a stronger bearish bar, and then subsequently a tiny little bar, which is another slightly bearish bar with a small body. Looks like price is coming back a little bit, kind of moving back and forth. Another slightly bearish bar, another slightly bearish bar with a bit of a gap, and then that's it. It's okay, well, I'm going to bail out. This is just too much of a hassle. It's not going anywhere. I can bail out. And then the next bar comes up, and it's a bearish bar. You get out here, and then the next bar goes to target. So the point is that you waited through most of it, and then just before it had the chance to get to target, despite the fact that your target and your stop was in pretty good shape, you bailed out prior to the last bar going to target. You can see you waited through all of that other noise, waited through it, and then got out at the inopportune time. Got in the time just before it went to target. Despite the fact that your calculations, your setup for the original trade was valid, so it wind up and it hit the target without you. So you got a break-even trade, or maybe even a slight loss, because of the fact that you weren't confident in how you set this up in the first place. Using the same, you have to see the original entry. This is the original entry at close. You do some candlestick math from the candle after entry to candle, from candle after entry to candle when the trade was exited. So you add all this together. You add all the bars to when the trade was exited, and you'll see that this is a bar that is just really neutral. You exit it based on this is the high, you take the low, you take the lowest part of the body, you take the highest part of the body, and you wind up with a doji. So things really didn't go anywhere. And all those bars, despite the fact that it whipsawed back and forth, prices didn't move. And if you were to exit on the second to last bar, you had exited in a situation where prices were just stuck. So if you move that back, you add all those bars together, you end up with just a neutral bar, basically a neutral bar. You would probably be more inclined to stay with that trade, particularly if you did the research on the rest of it and everything was fine. So that's really the summation of why candlestick math can be helpful. Because if you move that, if you keep that in mind and you have that really nondescript candle, to add them all together, you can see that those 10 bars that were added together just equal 1 bar, which was relatively neutral. Alright, let me show you in a real world example from yesterday. In this case, I've got this box marked off, this gold box, and it's marked off with, it encompasses these 16 bars. And in these 16 bars, from top to bottom, the Y value is 18 ticks from top to bottom. And as you can see, prices, a couple of bear bars, a couple of bull bars, slightly moved down, moved back up, moved down. Now I got it right up to this end bar, and if we add all these bars together, using candlestick methods from the previous example I showed you, then you'd wind up with a bar that looks like this. Prices moved up, it's moved down, but when it's closed right on this level right here. The next 2 bars in this line, if we added these next 2 bars over, you could see that it closes on its high, closes right on the high, over and above this. So this bar, it would look like this, a long taper with this. Now, if you're looking at these first 16 bars, and you look at this particular bar, trying to determine whether to go long or short, this is, well, so it's in green, but this bar here is just a doji. So you can see that the buyers and sellers are just in balance here. This bar, on the other hand, if you take this one by itself, you can see that prices had gone all the way down to this area, came all the way back up, and closed on its high. So this is more of a bullish bar. And as you can see, that if you were to wait on this, of course, they're both 18 ticks long. However, which bar would you be more inclined to go long with? Likewise, the reverse is true when it's short. So using candlestick math helps me get a little bit more clarity to the market, particularly when you're seeing prices go up on a run. And in this case, at this juncture, if you look at it from the perspective of off this bottom, prices moved up to this area. Now our price is going to continue up. And when you look at these bars in sequence, after a 21-minute period of time, or 22 minutes, you can see that at the very end of this line, prices just moved up higher. And would it go to now? This isn't just the only way you would determine whether to go long on this particular bar. But if our target is up here in this area, and you get a bar closing like this, it may give you more impetus to getting into that particular trade. At least that's the way I look at it. So that's how candlestick math can help you to give you some context to the market. And the nice thing about using candlestick math is that once you've practiced this for a while, you can start to see these types of candles on the chart in real time. And that's the point. When you can see these kinds of things in real time, you'll be more inclined to take the trade in the direction of where things are heading, even if you wind up with a reasonably tight trading range in what appears to be a pretty strong move up. Okay, that's it for now. This is Vance. Thanks for watching. Bye for now.